PP Singh, Executive Director and Chief Investment Officer Equities with Pramerica Mutual Fund joins us. Mr. Singh, good morning and thank you for joining us. Mr. Singh, looks like we've lost some way post 16th of May. Even the markets have got much more than what they ever dreamt of. The price action in large cap stocks has been rather inconsistent. Where are all the bulls?
Good morning. Well, once the confidence in the economy starts improving, the bulls obviously start spreading to the more number of stocks. The large cap stocks were doing very well in the period when the uncertainty was high. People were investing on the basis of the potential of the economy, but they were not so convinced. Now, post 16th of May, the conviction is obviously high, and as a result of which, you will notice that most of the investors are now spreading themselves into the other stocks where they see value, where they see the growth opportunities, which is more, and also where they see the under-ownership situation. And that's what explains why the mid-cap index has started doing much better than the large-cap index. So investor sentiment remains positive. It's just that it has now moved to the many more options which is available to them.
So, Mr. Singh, what is your sense? 5%, another 10% upside from these levels? What is it that we are in store with?
Well, if you are looking at the broader index, that is Nifty, then we are saying that by the end of the year you should see an index target of around 8,000 plus. Now, which obviously leaves, in terms of the percentage returns, something close to about 8 to 10%. However, you will see the individual, particularly if you move to the mid-cap sectors and you start see the outside those top 50 stocks, you will see the appreciation potential will be much higher.
Mr. Singh, the growth trajectory is looking encouraging, but bulk of the growth recovery and earnings will only come in FY16. So if bulk of the recovery is likely to come in FY16, why do you think markets will appreciate by 8-10% by the end of this year?
Well, if you see, even the government, the manner in which they are planning, and today morning only I was just looking into the plans, they are pointing out that there will be 2 years of consolidation followed by 3 years of growth. Now, market always runs ahead of what happens. When market gets an inkling that there steps are being taken to ensure that the growth comes in future, then they start discounting those growth upward. Whereas the same applies if you notice in the period 2009, post-2010 also, despite the fact that we were growing at the rate of 7% GDP growth, our market kept coming down. So the market always takes at least 8 quarters ahead of view. Now, if you go back to 2003 to 2007 kind of scenario, you will notice that the market appreciated maximum in the period between 2003 till 2005. Though in that particular period, the growth was not as encouraging as what you noticed in the period 2006 and 7, where market actually didn't perform as much as it performed between 2003 and 5. So the same number, same corporates, same index, which might appear at this point in time a bit costly, suddenly because of the index, the earning improvement which will take place because of the consolidation which we are speaking about, will result in they will appear cheaper, and that's what the investors are discounting at this point in time. Yes, there are a lot of risks because we start discounting what is right now being just planned. Now, there is a lot of risk of being implementation, and the market at this point in time is prepared to take that particular risk.
So what does one pick out, Mr. Singh, when it comes to the broader markets? Because really it's a wide buffet out there. While you do have the high beta pockets, you also have some policy sensitives, the likes of sugar, fertilizers, which are running up. And then, of course, you have the, trading favorites, the likes of the Adani names or the real estate pack, etc. What are you liking from the mid-cap universe? If you could give our viewers 3 names.
See, let's put it this way. When the rally or the bull market starts, everything starts running. So therefore, to become very selective in that particular period doesn't help much. However, over a medium to longer period, you will find that those who will be the natural beneficiary will start moving ahead. For example, market at this point in time is saying that even the people who are selling their businesses are good. because they are getting deleveraged without realizing that what they are selling is actually the breadwinners or the one which is actually earning income for them. So therefore, we will continuously get selective. Now, if you look into the policies at this point in time, the plans to have 100 cities, the plans to actually go ahead and use the water linkages, go ahead and clean the rivers, go ahead and do the reforms in the power sector. These are the kind of themes which, in our opinion, will result in a huge amount of performance of the stocks in these sectors. However, at the same time, you notice the metals are doing well, you notice that the real estate has started doing well. Like, I'll just tell you the simple logic. If you have 100 cities coming up, and to expect that the real estate prices will keep going up. Now, that's illogical. But market does behave a little bit illogical when the bull market starts, but gradually it will set in. So if you ask me the three sectors to point out, I will actually go ahead and point out completely closer to the infrastructure, that is 100 cities being built, the river linkages which are taking place, the power sector reform which is taking place, the coal mining, the opening up which is taking place. I think as far as the investors are concerned, if they focus on these sectors and the companies in these sectors, they are going to get re-rated very well.
Mr. Singh, every economy related sector, business, company stock in last 3 months and last 1 month has got re-rated. On an average, economy related stocks are up more than 50% from the recent low. But the telecom sector is still underperforming Indian markets. Now, telecom is always considered to be a proxy. It is always considered to be a proxy to economic growth. How come telecom is not bouncing back?
Well, telecom sector had some regulatory uncertainties in the recent past. And if you notice, with the new government also in place, we haven't yet come across any major discussion on this particular sector. Now, the companies are at this point in time consolidating themselves. Now, they are actually restructuring, selling out some of the businesses and deleveraging themselves. And clubbed with that, if you see the regulatory uncertainty getting cleared, you will see this particular sector performing in future. So, yes, we are actually positive on this particular sector, and we own these particular stocks. They haven't performed yet, but in our opinion, it's a matter of time when they will start participating in this rally.
Mr. Singh, what about the PSU banking pack? There is a holding company structure which is being talked about to raise, funds for the PSU lot. And this morning there are newspaper reports saying that RBI, is likely to revamp NPA norms, recommend joint lender forums as well. And that is what reports have been indicating. Do you think there are good prospects for the PSU banking pack in the days to come?
Well, besides the steps which are being taken by RBI to actually ensure that these banks do well, recent news which I heard is the finance ministry is considering to go ahead and have a bank where they can transfer their NPAs. What that means that the banks will become the PSU and the private sector, all those banks where we have an NPA uncertainty at this point in time, will actually immediately become clean banks. And it is quite essential that they become clean banks because a huge amount of infrastructure funding is being looked at this point in time. So these are the kind of steps which at this point in time is in the public being discussed, which will have a substantial positive impact on this particular sector. So all the valuation concerns which we have will immediately get corrected if such regulatory or the governmental steps are taken in near future.
Do you think now there is a big opportunity in NBFCs as a group, because if the economy recovers, consumer spending will also come back? What markets are currently doing is that they're only focusing on banks and they're only focusing on proxy plays. But if the economy comes back, one should also focus on consumer proxies.
Well, I completely agree with you, and that's the reason why in our portfolio we have gone ahead and increased our weightages on these stocks. Now, besides the fact that they will be a big beneficiary of what we are seeing in the economy, a technical reason also actually helps them, because most of the big banks at this point in time, you notice that they have hit the FII ceilings. So the incremental buying in those stocks actually is very difficult. As a result of which, the investors are now looking for those opportunities who have businesses may not be comparatively equal to what these banks which we speak about, but they are like a proxy. And so therefore the investors are moving in those particular sectors, and because of this technical reason also, they are expected to outperform the so-called strong banks.
Do you think in the short term quality will suffer? Because for the moment there is no evidence that quality stocks could take a backseat. Grow Finance, Jubilant Foodworks, Blue Dart, Jesdal, none of these stocks are cracking.
Well, some of the companies which you mentioned are, they are part of those sectors which we are talking about, or they are relatively less liquid in terms of the stock. So therefore, they do not truly represent. See, what happens when investors start participating in a bull market, there is always a leftover kind of feeling. So they go ahead and start buying everything, and in that everything, so actually the stocks which are not probably a best quality trades at a lower valuation, and so it gets immediately picked up. So quality does suffer in the early part of the bull market, but as we start moving ahead and the economy will start delivering, then the segregation will take place. Just to give an example, if a company today announces that they are going to sell certain assets and raise money and deleverage themselves, the investors are getting excited and buying that. But the fact is that what they are selling is actually the one which is earning money for them. So it can be looked from both the sides. But when you are in a bull market, you take the first point. When you get into the market where the first part gets over, then you start looking into the earning potentials of the businesses. So it's just at what stage you are in.
You've talked about your interest in infrastructure, Mr. Singh, but what about realty? Because that, purely because of its high beta nature, has really run up in the last couple of trading sessions. Do you think that's a trend or a trade where you would at all like to venture in, or stay away because of the high volatility nature?
See, if you see the manifesto of the ruling party, one point which they have clearly identified that they need to build up new cities. And why do you need to build up new cities actually? The very high land prices or the real estate prices are the reason why the incremental investment in this sector has slowed down. Now, the sector grows on volume, not on price. Now, so when that takes place and you're doing that kind of exercise, I would rather participate or through, say, buying a cement sector, or to buying those who are providing the construction equipment, or those who are going to construct it, rather than going ahead and buying the stocks which are actually probably have already exposure on some high price inventory, and then we'll be getting into the low price inventory. So yes, when one looks into this particular theme, I'm more focused on who are going to supply to this, and as a result, I will be a bigger beneficiary.
What about the valuation comfort? You like cement, but if somebody is planning to buy into cement stocks now, they are pretty much buying these stocks based on FY17 and FY18 earnings. I mean, ACC is trading at an EV per ton of more than $200 per ton. Gone are the days where Shree Cement was available at $100 per ton.
Well, you have a point, and that's where I initially pointed out that the stocks which were actually the quite preferred stocks in the initial period are no more, because the valuation comfort is not there. So, but if you look into the broader market, there are still many companies who are trading at a much cheaper valuation, though I may not like to get into individual names, but you can still come across quite many companies who are trading at a comparatively attractive valuations, and that's where you find that the performance is in those stocks at this point in time.
Mr. Singh, do you think in the short term, IT stocks will suffer, and they will suffer not because of business, not because of environment, but simply because of ownership or over-ownership patterns?
Well, one is over-ownership, and the second is that the euphoria which takes you to the extreme thinking. For example, when the new government came, the people started discussing that the rupee might appreciate to the levels of around 54, 55. And without realizing that at that kind of valuation of currency, the entire recovery process will stop, because looking at the way the currency in the rest of the world is. And now currency is getting back closer to 60. Similarly, because we are now quite excited about the domestic growth, probably we are ignoring that the US economy is also recovering, and which is actually the real business potential for these companies. Now, the stock market goes through that phases where at certain point in time, even a good companies actually do not perform, because people start focusing somewhere where the undervaluation is there. But if one looks at IT with even a medium-term outlook of, say, about 6 months, I think this particular sector will bounce back. Simply, if you look into there are three aspects which will actually help them out. One, US economy recovering. We do not see the currency actually appreciating much. And the third, if you notice, the manner in which the cost in the economy is coming down now, whether it is wages, whether it is in terms of the land prices, etc. So the policies which are being adopted by the government will result in the cost coming down, and all the three will help the sector. So therefore, this is actually a good time to accumulate, particularly for the investor who has a medium to long-term perspective.
Mr. Singh, so, it seems that the Commerce Ministry has already started the exercise of firming up, budget consultations which have already begun. What is your sense? What's the market expecting from this time's budget? Because that is being really looked upon as the next key trigger.
Well, I don't know about the market, but my personal view is that the budget is not going to be something which is big bang news, but rather it is going to be a lot of nitty-gritties, because and that's what is needed, because most of the things are in place. What is needed is to move them and implement them, and so therefore some of the steps which are being taken and the discussion or the news flow which is taking place from the government at this point in time is quite encouraging in that direction. I'm looking for, if you ask me personally, I'm looking for only two things from the budget. One is the certainty regarding policies, and the other thing is the indication about the implementation of GST. And these two things actually will have a substantial impact on the economy going forward.
Mr. Singh, two markets, two different interpretation. The equity market are pricing in a rate cut. They are of the view that interest rates will come down, but the bond market is suggesting otherwise.
Well, we believe that interest rates are not going to come down in a hurry, because it's just because by cutting interest rates you cannot bring the economy back to the shape or anything like that. And there's no scope at this point in time. In fact, what is more needed at this point in time in the market is to bring the depositors back to the bank, because that's where they will be moving away from the other asset classes like gold and real estate and get back to the banking system. And that's how the money, now the availability of money, in our opinion, is more important than making money available cheap, because those who are reasonably good in businesses will be able to take advantage of the available money. And when the banking system, we haven't yet cleared the NPA, I don't think the central bank will immediately take that kind of step. That's number one. Number two, if you see the government also, on the fiscal consolidation side, it cannot take the step of cutting down expenses too much, because the economy has already slowed down. So on the fiscal consolidation side, government will have to take baby steps in order to move ahead. So this doesn't leave too much of scope for an immediate rate cut, and at least we do not expect that in the current calendar year.